So does this mean, guys, that we have reached the peak for mortgage rates this year? This is the article that comments that the spread between the 10-year yield and mortgage rates improved last week. But again, I'm going to note this is just 1 week's of data. This is not the new trend, a new direction that is remaining consistent. So, what do we think? Mortgage rates went from the average of 7.37 and then ended the week at 7.08, which is a good move, but it kind of got stuck there, and I don't think that it's going to go below that.
No, well, I mean, if you paid attention to last week's Fed information that came out, nothing signaled that they were going to stop or bring it down anytime soon. And like I said in previous podcasts, the sentiment and the connotation you get from what they're saying is how the market takes it into consideration. And from what I've been seeing in the mortgage-backed securities, it wasn't going down after that, So I could expect that rates continue to either hold where they're at right now or slowly continue to creep back up to like the 8% range. But one thing that I did see was that, the market labor came out very strong. And one of the things that I wanted to point out that I wanted to get you guys' thoughts is what's going to happen once student loan payments need to come back to be paid. The time for you not to pay on those is coming up. So a lot of people that we approve when we run their credit, they have no payment on their student debt. Although we still have to hit them with the payment, now they're actually going to have to make that monthly payment, not deferred anymore.
Well, clarify. So when you're saying we hit them with a payment, we're not hitting with their actual payment. We're hitting with a proposed payment based on a certain ratio of what they'd pay every month, right?
Correct.
So one thing to be clear is that now that those payments become known and they become actual and reported to the credit bureaus, then it's going to be on the credit report with the true number.
True. So one of the ways that we use that formula, it's either if you don't report a payment on your credit report, then we have to use a certain formula to get that payment. But if you're already reporting a payment, we have to go with whichever one is higher. So at the time that your payments do come and you're getting approved, that formula may not be able to be there to save you anymore, and you're going to have to get hit with the full payment.
Yeah, and Andy, just piggybacking off of what you led with, how this is only a week's data. I mean, it's exactly that. It's only a week's data. I feel we got to take it with a grain of salt because, and going back off of what Brian said off of last week's podcast is we talked about interest rates possibly moving to the 8% mark. And one of the things that we talked about why it's moving to the 8% mark is if the 10-year bond closes, I believe it was 4.38%.
Yeah.
If it closes above that, we can expect it to move there. And we're already near that. So once again, we just got to take it with a grain of salt because it is only 1 week's of info.
But then again, paying close attention to this information right now is more critical than any because of the fact that how it could switch from 1 week to another. So for instance, one of my clients, we approved back on the end of just in the end of August on the 28th, right? We were able to give them a 6.125. Now I'm just quoting for example purposes, but this right here, this week it went back up to 7.125. So it's a 1% difference, right?
Wow.
1% difference.
And that was just 1 week.
And that was just 1 week from August 28th to today, basically, is what the difference. And you actually worked on Lauren's file, which you said the pricing for. Yeah. So that right there for me is very alarming because let's say you're looking for a house 1 week. The next week you're out of the game because you just lost literally $50,000 to $100,000 worth of purchase power.
Well, Brian, being that you're someone who has significantly more experience than me, what do you think a consumer who's maybe watching this or maybe one of our clients watching this, what can they do to prevent falling into that trap?
One of the things that I suggest is running your numbers at 3 different ways: best scenario, worst case scenario, and then a little bit higher. Because of the volatility in the market, what you get approved for on that day may not be the same case tomorrow. So with that being said, also stick very closely to your lender. Every week, rerun your numbers if you're not in a contract because of the fact that it could change very much, and then that could just completely break down your plan. So I would consider just staying on top of what's happening with the news. Find somebody that could be your source of information that you trust and continuously just update your numbers so that you're always having the most accurate information based on your case.
Yeah, that's a really important point because something that was also kind of brought up here, but I made a note to myself is that, this bond range that we're finding here, it's not over yet. It's not settled. It has picked a defined direction since the Fed started rate hikes in March of 2022, but we are still far from their estimated and their target inflation goal of 2%. So if we are to be in this bond window ago of, this 4 to 4.25, and if it goes higher than 4.38, we're going to see mortgage rates go all the way up to 8s. That we're not even yet close to where they need to be inflation-wise. So I think there's a lot more room in the tank, unfortunately, for that to change, for then us to really find what ground we're actually putting our feet on. The most recent unemployment number was 3.8%. We're looking for 4.5%. We got a ways to go. We have some time in the year left, but that's going to be some substantial pain in the market to get there, and I think that's going to come along with higher rates. So we'll have to see. Also on this, with mortgage rates, it does have this kind of loose correlation to listings and inventory, whether people put houses on the market or not. And we talked about this. Someone who has a house at 3% on their mortgage and they want to list it right now, they're immediately a buyer now at what, 7.25, 7.5, maybe even at their best day 6.75. Like, that's a huge difference coming from a house where you only owe 3%.
And that's something that, a lot of people come to consider. Even if they have all that equity from their last house, that rate's still going to make the payment, make you double think. And we had an example where, even on the renting side, some people can, afford a house for $3,600, 5 bedrooms. But, then you go look at what's, the current market, and you see an apartment, 2 bedrooms pushing the exact same or even more than that. And you really come to think like, wow, does renting even make sense anymore for certain people? And that's what I have been seeing with a lot of clients that come in. The first thing I always ask is, well, what's the goal and what's the motivation behind you wanting to buy this property? A lot of them are telling me the rents just doesn't make sense anymore. I literally look at the Zillow prices. I go online and I look at a mortgage and I look at my rent, and I'm like, those $200-300 I'm willing to sacrifice, in some instances even more, to be able to have a place where you're able to freely live and actually enjoy your life, and not just be in a small apartment or so.
Yep. As they say, the math ain't mathin'.
No, the math ain't mathin'.
Yeah. Oh. So with inventory, of course, we've seen really, really scarce inventory here in 2023. Where we're at right now is 10% lower inventory-wise than we were 1 year ago. But something that really struck my eye here was that in 2015, there were 1.25 million listings. And right now we have 508,000, which is 43% of that total. So we are talking about a number that is extremely substantial, not only from a percentage perspective, but that's a huge 700,000 difference, 700,000 units different. That is definitely putting price pressure and keeping price pressure on the upside.
No, of course, it's the golden handcuffs. People aren't willing to sell if the prices don't make sense. I mean, we're definitely seeing. I mean, if that doesn't prove the numbers and everything that we're talking about, I mean, I don't know.
Yeah, and I think so mortgage rates, obviously we're going to still see. Did we reach the peak? I'm going to say I don't think so. I would love to say we did and it's going to go down. I just think that's me being optimistic. If I'm being data driven, I'm saying no, we did not see the peak yet this year. What do you think?
As a loan officer, very optimistic. I want rates to go down. But looking at it from the data perspective and putting on my nerd hat, I don't think it's healthy for us to make the cut in rates just yet, because of the fact that we'd come right back up to where we're at right now. So I think they're doing a very, very strong and hard job to basically hold things off as much as possible, but I just don't see them bringing down rates just yet. I think that we're not done.
Yeah. So what do you think, Mikey?
I mean, don't get me wrong. Of course, as a loan officer too, I would love to see rates go down. But, being realistic, there's no signs pointing to that, to be honest.
And those are the hard conversations that I'm glad we're able to have, because of the fact that, it's not always, rainy and sunny and, everything's good. So I think a lot of people do need to come to the understanding that this is where we're at right now, and this is where we're going to be for a little bit, and it's okay. There's ways that we could get around it.
Yeah.